More than half of Americans are currently living the American nightmare, living paycheck to paycheck, feeling like they're racing against time, with debts that seem to multiply and the constant fear that their retirement will never come. Now, imagine you're walking down the street and suddenly you come across something unexpected, a small notepad forgotten on a shelf from none other than Warren Buffett. When you open it, you find the key financial rules Buffett used to build his fortune, with practical tips that will help you achieve financial freedom. In today's video, we're revealing 7 unknown sacrifices that will boost your financial life. And pay close attention because one of these rules is the turning point for many people. So watch the video until the end to find out.
But there's been an American nightmare that has accompanied that, and that's where people that equally have tried to get educated and worked hard and had good habits have found themselves living a life that's been on the edge throughout their entire lives, and the same for their children.
Number 1. Avoiding excessive spending on luxury. When we think of billionaires, it's easy to imagine stunning mansions, luxury cars, and private jets, right? Well, that stereotype couldn't be further from the truth when it comes to Warren Buffett. He's the 5th richest man in the world, but his life is notoriously simple, almost frugal. While many of us associate wealth with ostentation, Buffett sacrifices the immediate pleasure of excessive spending on luxury to maintain his pragmatic and strategic financial approach. Buffett lives in a modest home in Omaha, Nebraska, which he purchased in 1958 for about $31,500, equivalent to roughly $300,000 in 2024. Today, with his net worth of approximately $140 billion, he could easily live in a palace, but he chose simplicity. For him, the idea of spending enormous amounts on unnecessary luxuries is a pointless temptation that distracts from what really matters: investing wisely and sustainably. This sacrifice of spending on luxury is not a random decision. Buffett believes that to achieve true wealth, you need to have a mindset focused on long-term value, not material possessions that, in the end, only drain your finances. He often says that true wealth is not measured by what you own, but by how much you keep and invest for the future. Now, you might ask, but what does he do with all the money he has? The answer is simple. Buffett invests. He's known for his abstinence from impulse spending and his preference for long-term investments, like shares in Coca-Cola, American Express, and other major companies, whose stocks he bought decades ago and held onto. After all, the choices we make today directly impact our financial future, and spending on luxurious items today can mean a shortage of investments tomorrow. But can't you really spend your money on something luxurious or frivolous? Let's agree that life is meant to be lived. So how can you do that in a balanced way? Here's the deal. You can spend 10% of your monthly income on something that doesn't necessarily give you a return but makes you happy. It could be paying for a vacation, dining at your dream restaurant, or even going to watch a game of your favorite team. Sooner or later, you'll spend money on something that's not useful, so it's better to do it in an organized way. What's the biggest financial sacrifice you would make to maintain a balanced life? Leave your opinion in the comments. Number 2, not following financial fads. Have you ever caught yourself thinking about investing in something just because everyone's talking about it? In the age of social media and 24/7 news, it's easy to fall into the temptation of following what's trending. But for Warren Buffett, this impulsive approach is not part of his financial philosophy. He's always been a fierce critic of short-term investments and the temptation to follow financial fads, which can be as seductive as they are dangerous. Buffett, who has always preferred investing in solid companies with proven business models, has no interest in speculative fads. Instead of jumping into popular investments like cryptocurrencies or volatile startups, he's focused on stocks of companies like Coca-Cola, American Express, and even, until recently, Apple. These are companies with decades of operation and a proven track record of success. This doesn't mean he rejects new ideas, but rather that he cares more about the quality of the investment than the excitement of the moment. For example, when the dot-com bubble burst in the early 2000s, many investors panicked as their stocks plummeted. Buffett, on the other hand, stayed out of the frenzy because he knew the foundation of many of these companies wasn't sustainable. His decision to not get involved was, in fact, a financial sacrifice because many investors were making money, or at least seemed to be. However, Buffett didn't fall for the idea that everyone is doing it, so it must be right. Buffett's sacrifice in abstaining from following fads is ultimately the sacrifice of impatience. He understood that while the market can be volatile and uncertain in the short term, investing with a long-term vision is always more rewarding. Do you have any long-term investments? Number 3, prioritizing long-term investments. The temptation of instant profit is everywhere. Whether in the stock market, real estate, or even alternative investments, everyone is chasing that get-rich-quick opportunity. But Warren Buffett, one of the greatest investors of all time, has always been a fierce advocate of investing with a long-term vision. For him, building sustainable wealth isn't about taking shortcuts, but about following a slower, steadier path. Buffett is famous for choosing companies with enduring business models that can generate consistent cash flow over time. One of the most iconic examples of this is his investment in Coca-Cola in the 1980s. At the time, he purchased $6.2 billion worth of the company's shares, and to this day, Coca-Cola remains one of the biggest sources of passive income for Buffett, generating robust dividends and ongoing growth. Buffett's secret lies in not being seduced by fleeting trends. He knows that the fastest profits are often the riskiest. Instead of following the flow of what's trending and may seem promising in the short term, he invests in what has always had value: well-established companies with a track record of stability and resilience. A current example of this long-term thinking can be seen in his bet on Apple. In 2016, Berkshire Hathaway purchased about $1 billion in shares of the tech giant, and today that investment has multiplied several times. In fact, Buffett even sold part of his Apple stock because it was taking up nearly his entire portfolio. Buffett knew that Apple wasn't a passing fad, but a powerful and innovative brand with a consistent and profitable business model. Number 4, avoiding impulsive behavior in the market. When it comes to investing, many fall into the trap of impulsive behavior. The market is always filled with fluctuations, rumors, and the allure of quick movements, where it's easy to believe that an unmissable opportunity will pop up at any moment. But for Warren Buffett, impulsive behavior in the stock market is a major enemy of success. One example of this was in 2008 during the global financial crisis. While many investors were panicking and selling off their assets in a frantic attempt to minimize losses, Buffett did something that seemed counterintuitive. He bought more stocks. He acquired shares of Goldman Sachs for $5 billion, a move that at first glance appeared risky. But what seemed like an impulsive purchase from someone who didn't understand the risk was, in fact, a demonstration of his contrarian strategy: buy when others are selling. Another recent example was his decision to invest in Berkshire Hathaway and later in Visa and MasterCard. While the market was saturated with economic uncertainty, Buffett wasn't seduced by the widespread panic taking over the market, but stuck to his long-term focus on the quality and intrinsic value of those companies. He knew that despite short-term volatility, the true value of those companies was well positioned to grow over time. The discipline of not following the crowd, of not reacting instinctively to every market swing, is one of the greatest sacrifices you can make as an investor. Number 5, not focusing on easy opportunities. These days, it's common to hear about easy opportunities in the financial market, whether it's pyramid schemes, extremely high-risk investments, or the promise of making money quickly with something new like startup stocks or tokens. Buffett believes that true wealth comes from investing safely in companies he can fully understand and that have solid business models. A clear example of this approach occurred in 2006 when he made a major investment in Duracell, purchasing the company for $4.7 billion. Although the market was full of more sexy and innovative options, such as the burgeoning renewable energy sector, Buffett remained focused on products and services that had already proven sustainable over time. Buffett's sacrifice in this case is giving up on following trends and the now or never mentality. He has a strategy focused on investments with solid fundamentals, not on volatile businesses or the search for the next big thing. This philosophy can also be seen in his refusal to enter markets like Bitcoin or other cryptocurrencies, which he considers highly speculative and without intrinsic value. Number 6, the temptation of excessive diversification. In a world where we are constantly bombarded with information about different financial assets, the concept of diversification always seems to be the solution to all problems. Don't put all your eggs in one basket. This is a mantra often repeated by financial advisors and investors. However, excessive diversification can be a real sacrifice of focus and, in the long run, a challenge to maximize returns. If you truly understand a business and are confident in it, there's no need to spread yourself thin across dozens or hundreds of stocks. Instead, Buffett prefers to invest a significant amount of his capital in companies he believes are the best. Just like when he bought shares in American Express and Coca-Cola, which are two of his largest investments. Yet, he didn't diversify to the point of having a portfolio crowded with stocks from companies he doesn't understand well. Before investing in any asset, conduct a thorough analysis of the business. Ask yourself, do I really understand how this company operates? Can I track its progress over the long term? If the answer is no, it might be better to reconsider. Buffett invests only in companies whose business models he fully understands. Fewer investments mean more focus. When you have an overly diversified portfolio, it can be difficult to track the performance of all your choices. With a smaller number of investments, it's easier to dedicate time to evaluate progress and make informed decisions. Have patience and allow your quality investments to mature. Remember, the key is consistency and focus, not risk distribution. Number 7, abandoning the rush to accumulate wealth. In a society that values instant gratification, many people want to get rich quickly, often without fully understanding the true cost of this taste. The pursuit of quick results in the financial market, whether through stock trading, easy money schemes, or highly speculative investments, is a modern trend fueled by the immediacy of social media and the idea that anyone can get rich in a short period of time. But Warren Buffett has always been a strong advocate for patience, something he sacrificed in part by resisting the temptation of quick gains. In 1998, for example, when Berkshire Hathaway acquired NetJets, a private aviation company, many saw the deal as a risky and unnecessary gamble. Buffett had a clear vision: acquire a company with the potential for stable long-term growth, even if it didn't bring fast results. The first step is understanding that true wealth creation takes time. Instead of trying to maximize gains in weeks or months, develop a strategy that prioritizes solid, growth-oriented investments. If you don't have one yet, now's the time to start thinking about investing in quality companies or well-managed investment funds. To avoid the frustration of expecting immediate results, set medium and long-term wealth accumulation goals. This not only helps keep you focused, but also prevents impulsive decisions based on the expectation of quick profits. Now, the most important part: reinvest profits to harness the power of compound interest. One of the greatest forces in the investment world is compound interest, and the best part is that it accumulates faster the longer you leave your money invested. By reinvesting profits, you can accelerate your financial growth without rushing. Warren Buffett, known as the Oracle of Omaha for predicting major market movements, is already preparing for the next recession, which many analysts predict will occur in 2025. In his recent statements, he emphasized the importance of maintaining a substantial cash reserve during periods of economic uncertainty. Click on the video now to seize the opportunities of an upcoming recession. If this video helped you, please like it and subscribe to the channel. Good investments